The question that I get most often from people is, when should you sell your stock? And so that's what I'm going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the Q&A series. Now, of course, since the beginning of this channel, the question that you guys have always asked is, when should we be selling our securities? And so let's dive into that. And so welcome back to the Q&A series, where I try to take all of your most important questions and try to answer them as comprehensively as possible. And it's really come down to 4 reasons why I've sold a stock in my experience as an investor. And so here are the situations that I think are relevant to consider a stock sale. So the first situation is that the stock is trading substantially above its intrinsic value, and we'll dive into all of these in detail in this video. The second reason why you want to consider selling the stock, notice I'm saying consider and not actually selling the stock, is the stock is trading substantially below the price you paid for it. So first, the stock is trading substantially above. The second is when it's trading substantially below, and I'll break out all of these. The third reason why you want to consider stock sale is that your intrinsic value for the company has changed. And the fourth reason why you may want to consider a stock sale is that something changed with the company. And so let's dive into these. So with the first one, the stock is now trading at substantially above its intrinsic value. And so when I think about a stock trading substantially above its intrinsic value, I think about it being approximately 2 times its intrinsic value. And when that happens, you should probably ask a couple of questions. And so the first question that I would ask is, are there other securities on my tracker that are still cheap that can use some allocation of capital? So in other words, the situation that a lot of us are in right now, or probably will be in for the rest of our careers, is that we have more ideas than we have money. And so in those situations, if our company is trading substantially above its intrinsic value, well, we've made the return that we wanted to generate with that particular company. And so are there other opportunities that require more capital, or you can more profitably invest that capital in? And so you sort of have to ask that question, and the best way to sort of answer that is look at the particular tracker that you have built to track the intrinsic value relative to the share price of the company. Now, I offer a tracker, and in other words, it's really just the tracker that I use to invest my own portfolio. And so you guys can always access that, but I also highly encourage you to build your own trackers, because you will ultimately have a different intrinsic value for companies than I would. And so if there are other securities on your tracker that are still cheap and can use some allocation of capital, consider selling some or all and redeploy that capital. And now, this is not a recommendation for you to sell anything, but it's just a consideration. If there are not securities on your tracker that are cheap, that can use some allocation of capital, consider if you'd like to still take some profits to increase the dry powder that you have for future situations. There have been many situations in my investing career where, I was fully invested, and then some stocks did approach, substantially higher than their intrinsic value. And then I decided to take some of those positions off, and I just left it in cash. I didn't have anything else to invest in. However, it's nice to have that dry powder available when an opportunity arises. Now, before you do any buying or selling, anytime a stock swings really fast upwards or really fast downwards, I think the number one question you need to ask is, why did the stock move so much? Is there something that you're missing? And so that goes into this question here. Why has the value changed so much? Do you need to update your model? So by updating your model, you may change the intrinsic value to the point where the company remains undervalued despite it being substantially above the price that you paid for it. This has happened to me so many times in my career, sometimes to the upside, sometimes to the downside. So, before even looking at the tracker to redeploy the capital, don't look at your portfolio and see the gain or loss. Really what you should be doing is looking at your tracker and your model that you maintain for yourself, and ask yourself if this is still a opportunity. And this really comes down to that whole thing that Peter Lynch always talks about, where he says, if the stock is at $17, why can't it go to $20? Why can't it go to $25? Really what he's saying when he says that is, has the intrinsic value changed? And if the story has changed to the upside and it's still a substantial discount, or trading at a substantial discount to its intrinsic value, why would you ever want to sell it despite the fact that you have a gain? Now, sometimes people would recommend take some off the table. Yeah, I get that. But if the intrinsic value doesn't change or doesn't swing wildly, right? It just changes, and it could change quarter over quarter, but it shouldn't change substantially over quarter. And so if it increased substantially, you would expect that it should remain at that level of intrinsic value, hopefully by the way that you're valuing the company, because you're building in some sort of reasonable, predictable values or estimates or inputs. And so, if the company has done something that has substantially increased its intrinsic value and it's still trading cheap relative to that, then really consider why you'd want to do anything at all. I mean, you could be sitting on a potential 100 bagger because management continues or has shown that they can significantly increase the intrinsic value of the organization. And then that goes into that last point, that if you sell, are you sacrificing a substantial long-term gain for a quick double? And what I mean by that is that your model is not going to be able to tell you everything. All your model does is it shows you what the company is valued at today based on what you predict management is reasonably expected to do with a level of conservatism. However, as time goes on, the point of management is to surpass those expectations. And so if you have a management team that continues to knock it out of the water year in and year out, and they continue to increase the intrinsic value of the company, why would you not want to continue to partner with them? Those types of management teams, organizations, and industries are very difficult to find. And so if you find them, why wouldn't you want to stay along for the ride and increase your fortunes alongside some of the best operators in the world? And so that's why I would really consider if you're giving up a substantial gain for a short-term, quick-term profit. And so that might be a situation where even if it's doubled, I may not necessarily want to sell. Now, what I wanted to do is I want to give you guys an example of a very typical, very basic situation where you may run into as an investor in a security. We all could potentially run into a situation where, we invest in a company and they substantially increase the value, and, it's like an Elon Musk type situation, but that generally doesn't happen. What you generally run into is the company that you're invested in, the stock swings up considerably. However, you expect things to sort of like level out over time. And so what do you do? How do you sort of like interpret that situation? And so here's an example. I made a very specific example. So you own stock in company A with an EPS of $5 per share, and it's sustainable. It's not going up, it's not going down. It's just $5 per share. When you purchased it for $40 a share, you effectively got a 12.5% equity yield. I just put 12 just to round it, but they should have rounded it to 13, but whatever. It's 12.5% equity yield. The company returns capital only through share buybacks. A minimal amount is reinvested into the company, which achieves a high ROIC. You expect the shares to remain around $40 per share over the long term, adjusted for inflation, of course, and thus you expect a long-term annual equity yield of 12.5%. So effectively what they do is the $5 per share that they earn, they use it to buy back shares, and thus every year there's 12.5% fewer shares outstanding. Thus the EPS goes up by 12.5%. Using the same multiple, the share price should increase by 12.5% every year. So this is a very basic, simple example. You guys know that the multiple can fluctuate, et cetera, et cetera. And so here's an example of that multiple fluctuating. The share price jumped to $80 per share on no company specific or macroeconomic news. So you had bought the company for $40 per share, the share price jumped to $80 per share. So now if you just purchased the company for $40 per share, you're earning approximately $5 per share every year. And so it would take approximately 8 years for you to double this investment. However, it got doubled overnight. And so management, they're very capital savvy and decided to stop repurchasing the stock until the shares come back to that 8 to 12 times earnings per share range. Until then, they will just pay special dividends and pay down debt. And so what's really happening here is when a management team purchases shares that are substantially overvalued, you're destroying shareholder value. Just the same with the inverse relationship, where if management is purchasing shares that are considerably undervalued, they're creating accretive shareholder value. And so they're very savvy in this situation. They're not just going to blanket buy back shares. Now, there's a lot of companies that do, so be careful of that. And so in this situation, you can either take the $40 per share net profit now or hold on to the shares over the long term, and management is expected to deliver approximately $5 per share every year. And so in this situation, if I did not have any capital redeployment alternatives, I would probably hold on to my shares, because you know what, getting a 12.5% annualized return is very sufficient for me. I'm not looking to knock it out of the park. However, if I have capital redeployment alternatives and I can reasonably redeploy it, and I think, you know, based on the size of my portfolio, I think I probably would be able to redeploy that into something, assuming that it meets the portfolio diversification standards that I hold for myself, then I could redeploy it. But effectively what this is this is a situation where there's no easy answer. I'm fine if I just hold on to the security over the long term, but I'm also fine if I have a good redeployment opportunity. So in other words, a lot of you guys enter into this situation where, you know, just the natural volatility of the market could push you into a 50, 60, 70, sometimes even 100% gain. How do you handle that? The other thing that you got to consider is that sometimes your stock sales are impacted by taxes as well. And so you got to take into consideration the after-tax return as well for that particular situation. I just don't spend too much time thinking about tax, but you really should as it relates to constantly buying and constantly selling securities. So what we just did right there was a lot of analysis for just one situation where the stock price just went up. Very normal situation to happen, but you can see how it's a very nuanced discussion as it relates to selling a security. We all know why we buy a security. It's just trading substantially below its intrinsic value. But when it comes to selling a security, there's a lot of things to consider. Now, what happens in the opposite situation? So the stock now is trading substantially less or lower than the share price that you paid for it. So you had already purchased the company at approximately 50% of its intrinsic value, and now it's selling for 25% of its intrinsic value. What do you do in that situation? So this is that situation. So the stock is trading substantially below the price that you paid for it. And the way that I define this is that when the stock is trading substantially below or less than 50% of the price you paid, you should ask a few questions. So the first one is, has the story changed in a manner that brought down the intrinsic value accordingly? So that's the same question you would ask if the stock price ran up. You know, did the story change that brought up the intrinsic value substantially? And so if yes, consider selling some or all of it. Mistakes are allowed, and we take our lumps and move on. Now, the only thing that I would say here is that if it did bring down the intrinsic value accordingly, my question is, do you still have a substantial margin of safety? If you do, then maybe don't even consider selling it, right? But it really comes down to the situation and how your model is reflecting the current share price as a percentage of its revised intrinsic value. Sometimes the intrinsic value may not necessarily change, and so that goes into the next question. If the intrinsic value has not changed, consider if you'd like to concentrate your position with a double or triple down. Before deploying more assets in this situation, consider the landscape. Are there other more lucrative opportunities that warrant capital? So this is one of those situations where, you know, sometimes you guys get angry at me and you'll say, hey, you know, this stock that you said you liked went down a lot. Why didn't you buy them? And the truth is, just because some stocks go down doesn't necessarily mean that others also didn't go down, right? When securities decline, oftentimes they decline all at the same time. And so there might be other lucrative opportunities that warrant capital more so than the one particular security that you guys were hoping that I purchase. Also, it shouldn't matter if I'm buying the stock for you guys anyways. But so the urge to bring down the cost basis needs to be avoided at all costs if there are other better opportunities present. So this is one of those, you know, when we talk about value investing, oftentimes there's that feelings thing, you know, there's the having the emotional stability to not just want to see a lower cost basis in your portfolio. Hey, look, if you are just opening up your trading account every day and you're seeing that loss amount, don't just bring down the cost basis so you don't see that as much of a loss amount in your portfolio, like the gain and loss portion. You don't want to do that. And so avoid that at all costs. If there are other better opportunities present, don't allow that sort of like ego hit to stop you from making proper investment decisions. And at the end of the day, you are the only one that looks at your gain and loss position on your portfolio. Nobody else sees it. Also, you should probably not even be looking at it. Don't open up your trading account to even look at the gains or losses. And even if you have to make new trades, just go right into the trading window so you don't even see your gains and losses in the portfolio, if that's what it takes to avoid making ego-driven purchases. And so be very careful of this. Now, this is something that was an issue for me earlier in my career when I was very young investing, because I would hate to see lost positions. It would bother me. Also, consider tax loss selling if you can bring down your cost basis in that manner. And so one of the things that I love to do with my portfolio is I will take a position and not actually sell it, but I'll transfer it into another account. So like a tax efficient, like a 401k or something. In Canada, it's called the RRSP. And what that does is if I take something from my trading account and transfer it into the RRSP, it crystallizes the loss. So I get the loss that I can use for my margin account. The other thing that it does is the transfer into that RSP, or the 401k equivalent for the Americans. What that also does is it counts as an investment, of course, into your RRSP. And so that cost basis also deducts from your employment income. And so you get not just the crystallization of the loss, but you also get a deduction to your employment income as a result of that investment. And so you get this double benefit from just not even selling the security, but just transferring it. And so consider doing that stuff. Now, we also have the equivalent of a Roth, which is called the TFSA in Canada. And I do that with that account as well. So sometimes, I buy a security that's really like an income generating asset. And, the stock price has gone down. I want to crystallize some of those capital losses to apply it against some other capital gains. And so I'll move it into that TFSA or Roth account. And, I'm looking to hold that security for a long time. It's like just a nice dividend payer, et cetera. And so the beauty of doing that is I don't get an income deduction for that particular account, but I still get to crystallize the loss. So there's different things that you can do as an individual investor that the institutions may not have access to. Now, this is the situation that I hate the most. Nothing happened with the stock. The share price is actually at the same level as the price that you purchased it at. However, something changed with the intrinsic value, and now you have to make a tough decision. And so nothing happened with the stock, but your intrinsic value changed. So the first question you got to ask is, did the intrinsic value increase? This has happened to me many times before. And so I would say consider allocating more capital to the opportunity as it's trading at a larger discount to its intrinsic value than you purchased it. But before you allocate that capital, consider, look at your tracker and consider if there's other opportunities that warrant the capital more than this particular opportunity. Because again, we have a finite amount of capital that we can allocate with our portfolio. So there's that's a particular a solution for you in that case. Now, here's the one that really bugs me. Did the intrinsic value decline? So in other words, did I make a mistake in the way that I valued the company? Oh my goodness, have I ever done this? Especially earlier on when I was first starting to model out companies. And, I was self-taught. And so I would miss things. And then, as time went on, I would learn more and more. And then I would decide that, I didn't consider something for this particular opportunity, and I have to go back, and of course the intrinsic value declined significantly to the point where I didn't even have enough of a margin of safety. And so that always bugged me. And so this is the one that I worry about the most, and I believe that this is the one that investors don't think about the most. They think if you bought the stock and it hasn't gone down, you haven't made a mistake. Oh, I would disagree, my friends. I would say that that's one of the biggest mistakes we make as investors. We stop doing our homework after we buy the security, or we think that we're done learning. You are never done learning. And so the first question I would ask is, once you've admitted that the intrinsic value has declined, which, especially on YouTube, I see a lot of investors not even do this. The first question you should ask is, do you still have a sufficient margin of safety? If you do, consider maintaining your position. But if you don't, consider taking your lumps and redeploy the remaining capital. The other thing is, you still might have a sufficient margin of safety, but it's not as great of an opportunity anymore because the intrinsic value has declined. You might have bought it at what you thought was 25% of its intrinsic value. Then you changed the intrinsic value, you updated it, and now you own it at 70% of its intrinsic value. It's still a cheap or a reasonable investment. However, it's not as cheap as you thought it was, and so you might want to redeploy it anyways. And so this is the one that bugs me the most. It's the one that I worry about the most, and I believe it's the one that most investors don't think about. However, we should always be, and I'm sorry that I sound preachy here, but we should always be constantly doing the homework, constantly leveling up our own modeling skills, and constantly determining or questioning all of the inputs that we put into our models. And sometimes you don't know. And in those situations, what I like to do is I have a special section in my tracker, which is called the penalty box, because I'm Canadian, right? So we throw companies in the penalty box. And I just say, look, I don't know. I don't have the answer right now. I own the name, but I'm going to throw it in the penalty box until I can value it better, until I get more information. In those situations, I may consider just selling the security until I get a better understanding, or I may not. It's a specific situation for every particular opportunity. However, the point is, and the point that I'm trying to make with this question is, we need to be honest with ourselves with how we value these things. Look, it's very easy when it comes to investing and our egos to lie to ourselves. But the tough thing, of course, is to say, look, I want to be very honest with myself. I want to be very honest with the way that I'm valuing this company. I've made a mistake, or I didn't consider this thing, and this company's worth a lot less than what I previously thought it was. Now, there's another situation where you didn't make a mistake in the way that you value the company. However, and this happens very often, is something changed with the company. What do you do in that situation? Well, you have to decide what type of change it was. Well, here's an example. So the company is now taking on riskier investments. And an example was, I would say right before the financial crash in 2008, 2009, there was a bank that Warren Buffett liked a lot. Right? It was M&T Bank. It pivoted into subprime lending. That might have been an indication that we might want to sell that company, even though nothing changed with the stock price and nothing changed with our intrinsic value, because the company has entered into an investment area where it's a little bit risky and a little bit harder for us to predict. And so it violated question number 2 in the 4 questions that we ask when you value a company is, does this company have strong future economic characteristics? We don't know anymore because we don't really understand the subprime lending space. The second thing that could happen, and there's way more than what I have on the list on this list, but second thing that could happen is the company diversifies into a non-related business. And you can argue that subprime lending is somewhat non-related, but I would say it's related to lending. So the company diversifies into something non-related. So Zillow started investing into the iBuying business, and we all know what happened there. Conversely, however, Zillow became an interesting opportunity after it left the iBuying business, and it actually led to quite a bit of profits in the portfolio when I invested into Zillow, and everybody was writing it off. But if you had invested into Zillow because of the iBuying business, well, you invested into a situation where it's going into a non-related business. And if management are not experts in that business, they could also be drinking the Kool-Aid, right? And so they themselves don't know that they're making a mistake. Now, Zillow did come out later and say, look, we made a mistake. We drank the Kool-Aid. That's okay. M&T did the same thing. They actually came out later and said, listen, we drank the Kool-Aid a little bit, but we're going to go back to our what we are traditionally good at. Now, the third situation that could happen is management is no longer meeting its own goals. And so management sets out goals for themselves and they're not meeting them, and you would expect them to meet them. And so here's where you might actually want to change your intrinsic value. Look, if they're not meeting their goals, you got to be very conservative. In this situation, sometimes I throw these companies in the penalty box until I myself can get a better idea on how to forecast it out. Don't be afraid of saying, I don't know how to forecast it out, and thus I don't know the intrinsic value, and just selling it for that reason. The fourth one is suddenly there's an excessive amount of stock-based compensation. I'm not going to call out names, but there are some companies where, traditionally it was around 10% of their free cash flow that was being used as stock-based compensation. Then all of a sudden, with increasing free cash flows, they decided that 25% of their free cash flows were going to go to stock-based compensation. Well, with stock-based compensation, eventually you need free cash flow to buy back those securities to make the investing community whole. And so, in other words, it reduces the free cash flow allowed to the investor or going to the investors, and thus makes the company less valuable. And so this would bring down your valuation. So once again, you didn't miss it. You didn't make a mistake. The company just changed their compensation policies. And so you got to be careful of that and value that in. And then that might lead you to sell the company. And, a lot of the times this gets missed by the investment community. So you might be able to get out of the security before it comes down. And so but you got to pay attention to this stuff. This is why I say buying homework. The fifth one is a change in the strategy. So not just a diversification or riskier investments, but ultimately just a complete change 180 in their strategy. Be very careful with that kind of stuff. It might not work in the way that they're selling it to you. Next one is a material outside influence on the company's economics. Be very careful when the CCP begins to talk negatively about the company or industry that you're in. It might be an indication that you got to get out before they do something. The other area is, if the CCP and U.S. relations continue to sour, you might run into a situation where the CCP doesn't allow dividends or share buybacks anymore from the companies that you're invested in. They only want these companies to redeploy capital into their own country and with reinvestments. And so that those return on invested capital amounts will probably go down. And so it might be a time to exit that opportunity. Another one was, the impact of a pandemic and the new work from home economy had to the office real estate market. These are, changing influences or particular specific influences that could have an impact on a company's economics. And this, of course, had an impact on a real estate company's economics. So something to consider as businesses change. Another example of this would be, if you bought a newspaper company in the 80s or 70s, you would think that those moats for those newspaper businesses were impenetrable. However, by the 90s, early 2000s, you had the internet age, and now it's very difficult to sell a newspaper subscription. I can't remember the last time I got delivered a newspaper that I paid for. I stopped subscribing to newspapers well before even 2010 started. And so you can see that the internet effectively changed that whole business model for newspapers. And now the internet is changing the business model for TV as well. And, you're seeing, I believe that 100% of TV will be streamed through the internet, and your cable companies are going to be challenged in that environment. Most of them have embraced the internet, and so they deliver internet as well. And so they should be okay. However, it is another changing of outside influences. In other words, technology is changing, and so the company's economics have changed. Finally, new competition with the potential to significantly eat away at the company's moat. One thing that seems to be very popular is the chatbots as of the filming of this video, and so people are concerned about Microsoft encroaching on Google search dominance with a chatbot. And we don't know how this plays out into the future. There could be other technologies that encroach on search as well, and so a couple of years ago, we would all say that Alphabet's main product, Google Search, is impenetrable. It's got the best moat in the world. However, 5 years from now, technology could change in such a way where we may not necessarily think that that's the case. And so we have to start thinking about that early and see it early on. And so that might be something that violates that second question of, does the company have strong future economic characteristics? I would say that for Alphabet right now, with their search, I'd say they probably still do. However, there's one less crocodile in the moat that they previously had. And so it's less wide, I would say, than it used to be. So some of the water dried up is effectively what I'm saying. Now, you guys saw what I thought about when to sell a security. Warren Buffett was answered this question in 2002, and I think he gave a really good answer. And so here's Warren Buffett talking about when he considers selling a security.
Well, the answer, it's a very good question about selling. I mean, it's not our natural inclination to sell. And on the other hand, and we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. And We've held Coke stock since 1988. We've held Gillette stock since 1989. Held American Express stock since 1991. We had actually previously been an American Express in the 60s in Disney. So there are companies we're familiar with. We generally sell, well, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future. We think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we might have thought, as we thought it was when we initially made the decision. That may mean that we were wrong when we made the decision originally. It may mean that we're wrong now, and that their strengths are every bit as what they were before. But for one reason or another, we think that the strengths may have been eroded to some degree. A classic case on that would be the newspaper industry generally, for example. I mean, in 1970, if Charlie and I were looking at the newspaper business, we felt it was about as impregnable a franchise as could be found. We still think it's quite a business, but we do not think the franchise in 2002 is the same as it was in 1970. We do not think the franchise of a network television station in 2002 is the same as it was in 1965. And those beliefs change quite gradually, and who knows whether they're precise, whether they're right even, but that is the reason in general that we sell now. If we got into some terribly cheap market, we might sell some things that we thought were cheap to buy something even cheaper after we'd bought lots and lots of equities. But that's not the occasion right now.
And I think the main takeaway from Warren Buffett is that he likes to deploy capital in such a way where he doesn't have to sell it. And if the company's share price increases significantly after purchasing it, the first thing he does, and it's the same thing I talked about in the questions that I answered, is are there other opportunities? And the way that he talks about it is he will look in the sort of like environment and see if there's other opportunities that warrant the capital before he sells the security. Well, one way that you can determine if there are other opportunities is by having a tracker. Now, the one thing that I do is I actually keep a tracker for myself. Now, I just grayed out all the names, but you can see that on my tracker right now as of the recording of this video, there's 4 companies that are trading under their intrinsic value under 50% of their intrinsic value. There's a whole lot of companies that are trading under 75% of their intrinsic value. So the share price divided by the intrinsic value. And then, the remainder of the companies, and this goes way lower than this. There's about 100 and so names. The vast majority of the companies are trading at approximately their fair value or intrinsic value or above. And so the point that I'm making is, if the share price of your company, you purchased it at 30% of its intrinsic value and it went up to 91% of its intrinsic value. Look, it's still trading relatively in line or just approximating its intrinsic value. However, there might be all these other opportunities where you might want to redeploy the capital. You hold it at 91% and you might want to redeploy it into something that's 39%. So I use the tracker to easily determine that type of situation. And so I highly encourage you guys, if you don't have your tracker, number one, I encourage you guys to build your own tracker. That's for sure. But if you don't have a tracker, I highly encourage you to access the tracker that I give everyone access to, and it's effectively just my research. This is not a buy or sell recommendation service or anything like that. It's just access to my research and the way or my opinion on what I think these companies are valued at. And so you can access everything at this lower tier. And if you want to join us for an epic live presentation, you can join us at that higher tier. Now, I want to know from you guys, what do you guys consider the most important reasons why you would want to sell a security? Let me know in the comments below, and I hope you really enjoyed this Q&A series. And if you want to see a previous video of this Q&A series, you can get to that video right here.